A very good evening and a warm welcome to Personal Finance. I'm Gugulethu Cele. Now today I'm joined by Ewald Kellerman. He's the Head of Customer Interaction at Absa Home Loans. Good to have you with us today, Ewald. And the reason why we have you with us in studio is obviously to do a follow-up on a recent report that was published by Absa, which took a look at the changing dynamics in the living arrangements that people are viewing. If you could give us a quick overview of some of the insights that came out from there.
Yes, of course. And thank you very much for having me on the show. So the Absa Homeowners Insight is a survey that we conduct digitally with a couple of our customers. And it's really to try and understand how consumers' needs are changing and what exactly a consumer wants from the market and from a home loans bank. So the latest one that we did looks at the pre-buying phase when people are in the process of making decisions about property. And it was quite fascinating for us, even though we've been in the market for so long, to see exactly how consumers' needs are changing and what consumers are looking for. You know, so a couple of the highlights, and I'm just going to try and summarize before we break down into it. But the biggest portion is that people are taking a lot better to high-density living. What we see in around the rest of the globe of cities that become more populated and more densely populated, where people share communal areas, where people share costs in apartment blocks and complexes.
So complex kind of living is picking up.
Of course, yeah. So complex, where we call it in South Africa, we call sectional titles. Yes. A way of explaining it. So a sectional title means that you own a piece of your own property, and then an undivided share of the common property. So that would be your lift lobby or your communal pool or the security gate. And still, most of our consumers prefer full title, freestanding houses where you've got your own property. But it's becoming increasingly more acceptable to live in a communal type property for obvious reasons, and cost being one of the biggest ones.
Walk us through some of the costs, because I think sometimes there is a misconception maybe that one option is slightly cheaper, or is it so? One person who has a freestanding home, do they find that the costs actually multiply because you take care of your own garden, you need to take care of the gutters if they have an issue, and even security issues as well? That's
correct. It's a very good point. So you know, from the work that we've done and from what we understand from our consumers, there is a very, very big difference in the operating or the running costs of the property. So full title, the way that you pay your costs is a rates and taxes statement. There is typically electricity and water and sewage, etc., separately on your statement. While in a complex or sectional title unit, you pay rates and taxes, but then you pay a levy, and that levy goes to the body corporate. That body corporate typically insures your property as well. So the differences between the costs is it still costs the same in terms of rates and taxes, and it still costs the same to maintain and paint the house. But the benefit you get from a sectional title is that where you were completely responsible for your own electricity and for your own maintenance of the garden, the pool, the security company, etc. In a sectional title setup, you share those costs with your neighbours. So you can afford to have a 24-hour guard at the gate. You can afford to split the costs of maintaining the pool with the other 20 people in the same complex. So that sharing of costs makes a lot of sense and makes it a lot cheaper to live in a sectional title unit.
You mentioned something interesting, which is insurance, and which is obviously a big issue when it comes to not only home insurance for the structure itself, the contents inside, and even homeowners insurance. But did you see any interesting trends with regard to that as well?
Not quite. It wasn't one of the areas that we focus on specifically. But I think that the insurance industry around properties is still quite largely misunderstood. There's two different types of insurance you get essentially. So the assurance part, where you insure your life, which is something that we advocate to customers, is a very important part of protecting your estate, protecting your family's financial well-being later on. And that we encourage customers to take, but we can't force them to take it or require it from them. But the part that we can to help protect the property is what we call homeowners cover.
Yes. So
in a full title property, you have to have homeowners cover that protects a building, and typically things like geysers, etc. If your property were to burn down and you've got a bond over that property, what happens in that case? And that's where the homeowners cover kick in. So as a bank, we require you to have homeowners cover. We obviously offer homeowners cover ourselves, but we don't require you to take it. Even though we might have a good product, we just require some sort of cover in place in order to protect you if something happens, and obviously in turn to protect our security so that we've got something to fall back on if the loan does go bad.
We know in South Africa it's not often that people tend to live in the same house for quite a long period, and even if they do, I mean, the stages and different people would obviously live in that particular property. But are we finding that the older people get, maybe they look to downsize their homes and properties, and even those who are young and starting out in their 20s often prefer to live in a smaller kind of establishment?
Yes, and Gugu, I think that was one of the biggest findings of the report, is how exactly the life stage matches with the property. Young people typically finishing varsity or earning their first salary, they can't necessarily afford a larger home.
Yeah.
So they're more willing to compromise and stay in a flat or a townhouse. Once you start getting a small young family, then your need for having things like pets becomes quite important. And the normal flats and townhouses they're not always pet friendly. So that would necessitate you to have your own property. As your family grows, you start living outside a lot more, perhaps entertaining more at home. So your need for a garden becomes larger. So the young family said that they've got a much stronger need relative for the garden. And I think probably more than ever, maturers are starting to move out of their large properties and starting to sell those large full title properties which we were all used to living in, and moving to something more manageable, safer, and also cheaper to maintain.
Something that's quite obvious that stands out here is obviously the costs, and you obviously sit probably and deal with the interface regarding the clients and affordability, but what are the rates like? Are we finding that South Africans can afford their properties and often get 100% bond approval, or are we finding that South Africans do take that responsibility to build up a suitable deposit and use that to aid their funding abilities?
Gugu, it's a brilliant question, and something that we're struggling with on a daily basis. A lot of South Africans do save and do have a deposit. And if you do have a deposit, you get obvious benefits of paying down a smaller loan, but also benefiting off a much better interest rate. Because a lower percentage loan is a much better risk for the bank. So we could pass all of that cost, all of that profit back to the customer. So if you can afford a 5 to 10% deposit, you end up with paying a significantly lower debt burden. But unfortunately, the reality in South Africa is that the savings rate is so low, and the transfer cost of properties is quite high. So most people moving into property still require quite a large or a high percentage loan. And for the right customer, for good risk customers who've conducted their accounts well, not just the check accounts, but also other credit accounts at other retailers, etc. We do offer, and the industry does offer 100% loans for them. So you can still get a 100% loan, but it's sort of reserved for the best customers. Typically, we require a 5 to 10% deposit.
On those customers, though, are they also managing to treat their loans quite fairly? Because there's a trend that has also picked up where people try to pay down their loans as fast as possible, and maybe even use the excess payment as an alternative to a personal loan. So whatever extra they paid in, they might come back and use, and then even continue paying their loan as a result thereof.
Yes, so it's a very nice mechanism of a home loan, and something that you could generally do. In fact, we encourage our customers to pay down the home loans quicker where it makes sense. We all for writing good business to good customers, and if they decide to pay down their home loans quicker, we celebrate that fact. We obviously make money out of how much we lend, but we don't try to keep the balances as high as possible. We encourage the good use of that. And I think a very big trend that we've seen in the last couple of years, and probably since 2007, 2008, when we got into a lot of trouble with our lending practices and the way that the economy went, we've been very particular about the type of customer we onboard. So we're very, very picky of who we pick and who we lend to, and we've had very good success with picking the right customers. So the type of customer we write today is a lot healthier, and we are a lot, I think, more careful of what we write, how we write, and what type of loan we give them. So giving somebody a 100% loan is a good thing, but also if you tell somebody you can't afford that property right now, you should perhaps look at something cheaper. That's not bad advice. I think that's good advice, protecting both the customer, his family, and the bank.
Which makes sense, because if you can't afford it then and you can't pay it off, then you're going to end up in a worse situation anyway. But what about that all-important question when it comes to home loans, to fix or not to fix your interest rates? Some say yes, some say no, but I'm sure you're going to say it depends on your situation and circumstance, right?
Well, I think maybe I can go a little bit deeper than giving the vanilla answer.
Yeah.
I think if one invests money, you've got a certain risk tolerance. So, perhaps that fits with your lifestyle. So if I'm risk averse and I want to make sure I get a return, guaranteed return on my money that I invest, I would pick something like a savings account because it's quite safe. Now you might have a larger appetite for risk, so you're willing to lose a bit of money, but when you make money, you want to make sure you make a lot of money. So you might choose shares or an equity portfolio to do that. Well, in the home loan environment, it's similar. So if I didn't have a big risk tolerance and if I can't afford to interest rate increases, which is likely to happen, then I would buy I would fix my home loan because it gives me that certainty, it gives me that comfort that it doesn't matter what happens with the economy, that makes sense to me. But you might have some extra cash available and you're willing to take the chance. And then you decide not to fix. But when the rate goes up, your home loan gets a bit more expensive, and when the rate goes down, it gets a little less expensive. So it's almost more to do with your risk tolerance more than trying to beat the market. I think that's not something which I would recommend to anyone with a fixed rate is to try and beat the market, because as good as our forecasts are, we don't know what the future will hold.
Well, let's get a quick recap of the takeaways from tonight's discussion. Ewald, we've certainly said quite a bit and people have learned quite a lot from our conversation, but if there are a few points that you think that they should have to remember tonight, what would they be? Well,
Gugu, I think to start off with, most of our respondents in the survey still stated that they would like to own a full title property and a full title freestanding property. The reality is that full title freestanding properties are very expensive to maintain. There's a lot of realities and practicalities around that, which might make it difficult for ownership later on. We see that there's different, from the respondents, we see that depending on your life stage, your property needs changes quite vastly. And perhaps to add on to the earlier conversation, I would go as far as to say that in a couple of generations to come, full title properties around city centres will start disappearing, and it would become a luxury that not the norm that we see today. I think just to finish off on the affordability section, it is still difficult to get a 100% loan, but banks do offer a lot of finance. But the banks are very interested in making a deal work for both the consumer and itself, so that you can afford it, and we make sure we set you up for success.
Precisely. Ewald, it's been an absolute pleasure speaking to you today. Thank you so much for your time. And that is where we have to leave it for personal finance, unfortunately, tonight. A big thank you once more to Ewald Kellerman. He's the Head of Customer Interaction at Absa Home Loans, for joining us tonight. Remember that we want to hear from you and give us your thoughts. Are you also moving away from a freestanding home and prefer sectional title living? Well, tweet your comments to @CNBC Africa using the hashtag Finance410 or to myself @Gugulethu on Twitter. Until next time, take care, everyone.